Hi guys, Casey here. Happy New Month to you. A quick one. I appreciate everyone who joined the last live section. We ran into some technical issue that cut things short. Oh fuck, guys, pardon the background noise. I'm at the village and the noise is too much. So, but I've recorded this section so you don't miss anything. Without further ado, let's get straight into what we were meant to cover, which is directional bias. So when I say directional bias, well, what am I trying to say? You all know about directional bias, but do you understand the logic behind directional bias? Let me explain. Directional bias simply means a clear sense of where you expect the market to move, whether bullish or bearish, before taking any trade. Alright? It is the foundation of every trading decision because it helps you align with the dominant flow of the market instead of trading against it. It helps you align with the dominant flow of the market instead of trading against it. Alright? In other words, your directional bias tells you which side of the market you should be on. So your entries and setups all move in harmony with the bigger picture. Let me type. You can take a note, or maybe you have the recording already. You have the recording, you can rewatch anytime you want. Paste. I will have to paste, right? Sorry. Let's look clip. Fuck, what am I even doing? Oh, clipboard. Alright. Make it visible. Alright. This is the bigger picture. Yeah, so it simply means a clear sense of where you expect the market to move. All right. Now let's get into the charts. We are on US oil. This is US oil, the daily time frame. You can see that above. Let me delete. So, according to your mentor, I mean the video you watched, Tony Ike's mentorship, he has three models of directional bias, which is the support and resistance bias, the trend bias, and now the SLP bias. Let me explain. Let me delete this. What I mean by the support and resistance bias is this. You have your resistance here. And then you have your bias here. Your support, sorry, here. On the higher time frame, daily time frame, as you can see. This is the daily time frame. You all can see that. So The support and resistance bias works like this. Let me show you with the example. The daily market moves, making series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, until it gets to the resistance. When it gets to this resistance, you expect the market to change character or market structure shift. You expect to see a market structure shift, then the market starts trending down. All right, that's the support and resistance bias. Then when it gets to the support, you expect another bounce from here, and we start going bullish again. All right, that's the support and resistance bias. Again, the second one is the trend bias, trending market bias, knowing whether your market is in, knowing whether the market is in an uptrend or downtrend. Let me show you the example also. Still on the higher time frame, you see the market making series of higher highs, higher lows. That's trending up or maybe trending down. When you see this, you know that the market is in an uptrend, right? Then you refer to your lower time frame, 30 minutes, 1 hour, 15 minutes, then start buying because the market is in an uptrend, or maybe the other way around, vice versa. But me, I only use our normal entry model as my bias. What do I mean by that? I want to see a break of structure on the higher time frame, the inducement, then our POI. All right, this is what I use. This is the only model I use. This is our order block, and this is the daily time frame. Then I'll go down to the 30 minutes time frame or 1 hour, depending on where the chart is clear, to look for my confirmation, which is the entry model. The entry model is still the same thing. It still resonates around market structure shifts, break of structure, inducements, order block, and breaker block, right? Then I go to the lower time frame. On the lower time frame, you will see something like this. You will see something like this. No, okay. Let me use another example for the lower time frame. On the lower time frame, you will see something like this. This particular move that come down to trigger your order on the daily time frame, to trigger these buys, to continue these buys on the daily time frame. If you go to the lower time frame, it will be a trend also, making series of lower highs and lower lows, lower highs and lower lows, lower highs and lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. And then after triggering the order block, the daily order block, you see something like this, a change of character. All right, you see a change of character on the lower time frame. On the lower time frame, this is the lower time frame, this is the 30 minutes time frame, and this is the daily time frame. All right, this is what it looks like on the daily time frame. This is what the move looks like on the daily time frame. It could be one candlestick, it could be two, but on the 30 minutes, it's a trend, a complete trend, a whole new trend. All right, it will be moving this way on the lower time frame, and it will be maybe a single candlestick or two or three, just a few candlesticks on the higher time frame. Then when you go down to the lower time frame and this happens, what do you want to see? You want to see the market pull back, giving you your inducements, moving up, and then coming down again to trigger the order block on the 30 minutes. This is where you enter your trade on the 30 minutes, targeting the opposite liquidity. All right, this is where you enter your trade, targeting the opposite liquidity. This is your entry. then you target the opposite liquidity. Stop loss below the other block. All right. And now, since the market is moving up, what do we expect this daily time frame to do? We want to see the daily time frame clear this high. This is our inducement, and our inducement serves as the internal range liquidity. This is the internal range liquidity. All right. While our target is the external low liquidity. When the market clears this internal range liquidity and triggers your order, whether from your breaker block, your order block, anything, then it goes to clear the external range liquidity. In other words, you should be buying on the lower time frame, only buys on the lower time frame until this high is taken. All right. You take this setup, hit your take profit, wait for the market to either pull back, giving you the inducement. All right. Inducement going up, then coming down to trigger again from an order block, a breaker block. You buy until this high is taken. That's how you trade the directional bias. However, in some cases, hold on. In some cases, you might see the market doing something like this. Doing something like this, moving closer, pull back, then go back to trigger order block from this side and clear this low as the external range liquidity. Yeah. In some cases, you must see something like this. And why this happens? Whenever a higher time frame, a bigger time frame, maybe weekly or monthly, is bearish, why this daily is bullish. That's why I advise my mentees to do their top-down analysis. Go from the monthly, the weekly, the daily, the 4 hours, to know the clear picture, the bigger picture of the market trend, right? Because some people will be holding, some people will enter from here, some people will enter from here, trying to swing, to hold the trade until it clears this high, and the market will reverse against them and mess their psychology up. That's why I advise you take your profit. If it gets to this other block, you wait and observe to see if the market will give you another lower time frame, change of character, market structure shift, break of structure to start selling. Just trade what you see. Don't trade what you think. Just because you feel like, oh, the market should clear this external range liquidity doesn't mean that the market will. Trade along with the market movement. Take your lower time frame trades, take your profits at the normal take profits, and watch what will happen here. Take the reaction here. All right. If the market gives you another market structure shift, you sell. It might even move to this point. It might even move to this point, creating another inducement here, then tap through this breaker block and continue its moves. This can happen. So just trade, follow the market, watch what's happening on the charts and trade alongside it. All right, let's get to the charts.